All right, Marcus here, and I need you to lock in for the next few minutes because gold just printed around $5,178 an ounce, up about $94 on the day, and silver is ripping near 93/66, up over 6%. And before you repeat the headline that's flying around, gold hits 5,494, silver 120, Iran goes nuclear, markets closed. Pause. The real signal isn't the meme number. It's the mechanism underneath the move that's already happening in the plumbing. Because when gold can climb like that while policy is still tight and while stress gauges are elevated, VIX near 18.6, gold volatility GVZ above 33, that's not normal risk on. That's the market telling you something about liquidity and collateral. Not a meme, not a rumor, not just a chart move. If this isn't speculation, what is it? Here's the immediate personal impact. If you're holding safe portfolios that depend on smooth trading, stocks, bond funds, even cash-like products, you're exposed to one thing you don't control. The system staying orderly when it has to settle trades under stress. And this weekend is exactly the kind of backdrop where order gets tested, because geopolitical shock is hitting while cash markets are shut. And the first real price discovery happens when futures reopen into thin liquidity. Over the weekend, reports describe a major escalation involving US and Israeli strikes on Iran, with immediate concern centered on energy flows and the Strait of Hormuz. That's the setup. Now here's the stake expansion, fast, simple. Imagine you have $100,000. You keep $80,000 in broad index funds and bond funds, $20,000 cash. You think you're diversified, but in a liquidity shock, those are all claims inside the same settlement machine. If volatility spikes and dealers pull back, your diversification can become one crowded exit. And when precious metals start accelerating in that environment, they're not just moving, they're repricing counterparty distance. That's the signal. Now the promise lock, because I'm not here to give you hype. I'm here to give you structure. By the end of this video, you're going to understand three things. What this move in gold and silver actually signals about the broader system, why mainstream headlines miss the mechanism, and how to position structurally without chasing price or gambling on targets. Most people miss this next part, and within the next few minutes, I'm going to come back and answer the questions that should be bothering you right now. If liquidity is fine, why is gold acting like a stress asset instead of an inflation asset? If you own gold through an ETF or futures, what do you actually own when settlement gets stressed? If the Middle East escalates and energy becomes the transmission channel, where does the first break show up? Funding markets, credit spreads, or exchange inventory? And if markets are closed, what does that really mean? Closed for you or closed for price discovery? Hold those, don't resolve them yet. If you leave early, you miss the real explanation. Here's the mechanism reveal. This is the two-layer structure that runs almost every market, especially precious metals. Layer 1 is financial exposure. ETFs, futures, options, swaps, leveraged products, unallocated accounts, custodial IOUs. That layer is massive because it's efficient. It gives you exposure with a click. It's liquid, it's scalable. Layer 2 is settlement reality, physical custody, deliverable inventory, vault stocks, bars that can actually move, collateral that can actually be pledged. In calm markets, these layers align. Paper claims trade, and everyone assumes the underlying can be sourced if needed. Price discovery happens mostly in the exposure layer, and settlement rarely gets tested at scale. But when confidence shifts, alignment weakens. People stop caring about exposure and start caring about control. A clean example, say 100 investors each want 1 ounce of gold exposure. In the paper layer, That might be 100 ounces worth of claims, but the system can support far more claims than immediate deliverable supply because most participants roll contracts, net positions, or settle in cash. That isn't a flaw, this is the design. Now listen carefully. When stress rises, the game changes from who has exposure to who can settle without depending on someone else. That's where paper versus real ownership stops being a slogan and becomes a balance sheet problem. Now let's build the stress chain, because this is where the move in gold and silver stops being a commodity story and becomes a macro story. Start with policy. The Fed's target range is still 3.50% to 3.75%. Funding isn't free, carry isn't free, leverage isn't free. SOFR, real overnight collateral funding, is around 3.67%. So if someone is running leverage in any form, futures basis trades, relative value, hedge overlays, there's a real cost to maintain the position. And when volatility rises, margin requirements rise too. We've already seen exchanges respond to volatility in metals by hiking margins in recent weeks. Not panic, not rumor, not Twitter. Now add liquidity conditions. The Fed's balance sheet is sitting around 6,614 trillion. That's not expanding rapidly. And while the reverse repo facility is not the dominant sink it once was, it's still showing activity, around $16.3 billion recently. That matters because it speaks to where excess liquidity is and where it isn't. When liquidity is abundant, the system can absorb shocks. When it's thin, shocks travel through funding spreads and collateral haircuts. Now add credit. High-yield spreads, one of the cleanest system stress thermometers, are near 2.98% on the ICE BOFA high-yield OAS series. That's not a crisis number, it's not 2008, it's not March 2020, but it's a baseline. It tells you the credit market is not screaming yet, and yet is the key word, because that's where gold's message becomes dangerous. Gold often moves before credit admits there's a problem. That's the trap. Now layer in volatility. VIX is around 18.63, not extreme but elevated versus complacent regimes. And gold volatility, GVZ, has been printing in the low to mid-30s. When gold volatility rises with price, it's telling you something. Demand isn't just allocation, it's urgency. That's the stress. Now, geopolitics as the accelerator. This weekend's escalation around Iran isn't just headline risk. It's a potential collateral shock through energy and shipping lanes. Reports describe tankers halting or avoiding the Strait of Hormuz area after the strikes, and markets are staring at the risk premium in oil. And here's the key. Energy shock feeds into inflation expectations, which feeds into rate expectations, which feeds into funding costs, which feeds into leverage behavior. That chain is why metals can move hard, even when the Fed is still restrictive. Now let's address the markets closed piece, because it's not just drama, it's structure. When headlines say markets are closed, what they really mean is cash markets are shut, liquidity is thin, and the first institutional repricing happens in futures. That's where gaps form. That's where forced hedging hits. That's where margin calls start before your brokerage app shows you the full picture. So you get a situation where gold is bid, silver is bid, and the most important thing isn't the last print. It's what happens when the system has to clear and margin those moves. That's where it breaks. Now let's talk about the part everyone ignores. Settlement reality in the metals complex. Gold futures are actively trading with prices around $5,296 on CME's gold futures page, reflecting strong moves. Open interest has been hovering in the low 400,000s in recent sessions, with one report showing open interest around 403,575 contracts at the end of February 27. Open interest is not good or bad by itself. It's a measure of how much paper exposure is outstanding. And when a shock hits, here's what matters. Does paper exposure expand faster than deliverable inventory? Or does deliverable inventory get drained while paper claims stay large? Because that mismatch is where settlement risk shows up. Now, on inventory, COMEX warehouse stocks are tracked and published by the exchange ecosystem. And third-party dashboards aggregating COMEX inventory have been showing figures like roughly 17.1 million ounces of gold and 86.1 million ounces of silver in COMEX inventory as of late February. I'm not using those numbers to claim an exact available supply for delivery. Eligible versus registered matters. Ownership matters. Loadout timelines matter. I'm using them for one reason. When price accelerates under stress, inventory trends become a pressure gauge. That's the risk. Now let's bring in the ETF layer, because this is where ownership versus exposure gets real for retail investors. GLD holds physical gold to back shares, and reported holdings have been around 1,086.47 tons in late February. SLV is designed to reflect silver prices and holds silver in trust with its own custody structure. Again, this is not anti-ETF. ETFs are efficient tools, but they are still part of Layer 1, exposure mediated by custodians, authorized participants, creation-redemption mechanics, and market liquidity. In calm markets, that's fine. In stressed markets, the question becomes, do you want price exposure or do you want liquidity control? That's where the difference between I own gold and I own a claim tied to gold's price becomes meaningful. Now we're ready for pattern recognition, because this is not the first time a geopolitical shock hit a tight liquidity regime. Think about prior moments when funding markets were tight, volatility rose, and suddenly safe assets behaved differently than people expected. The common pattern is always the same. Leverage gets more expensive. Dealers get less willing to warehouse risk. Liquidity thins. Then price gaps appear in the instruments people assumed were always liquid. And the lesson is brutal. The stress doesn't announce itself with a siren. It shows up as small dislocations that compound. The lesson wasn't learned. It was postponed. Now here's your mid-video reset hook, because if you're still thinking this is just a metals rally, you're missing what it means for everything else. If you think this is just a price move, you're missing what it signals for the rest of the system. Now let's pull the camera back and deal with the $5,594 gold or $120 silver headline. As of the latest verified spot quotes, gold is around $5,278 and silver around $93.86. For gold to be $5,494, it's roughly another 4% higher from here. For silver to be $120, it's roughly another 28% higher from here. That gap is exactly why you should not anchor on the meme number. The number is not the message. The message is that both metals are already moving in a way that matches a system that is paying up for hedges under uncertainty, while funding is still costly and volatility is not asleep. Now we transition to agency, because you don't need a price target. You need a plan that respects the structure. So here's how you position. 3 asymmetric plays. First, increase liquidity control. That means you prioritize instruments and allocations that you can actually manage during a fast market. Accessible cash buffers, staggered entry timing, and avoiding structures that force you to sell into volatility. Second, reduce counterparty distance. That means you reduce the number of links between you and the asset you think you own, especially in your insurance sleeve. Fewer intermediaries, clearer custody, less dependence on flawless settlement. Third, preserve optionality over leverage. That means you stop treating leverage like a default tool. Optionality is the ability to act when others can't. Leverage removes that ability because it introduces margin calls and forced decisions. No buy calls, no sell calls, no targets, just structure. Now we go to acceleration signals, the things you watch next, because timing matters. 1. Volatility expansion. VIX around 18.6 tells you the market is not asleep. 2. Gold volatility elevated. GVZ around 33 says demand for gold hedges is real, not casual. 3. Funding cost still high. SOFR around 3.67% means the carry environment is still restrictive. 4. Policy still tight. Fed funds target range 3.50%, 3.75% keeps pressure on leveraged positioning. 5. Geopolitical supply chain stress risk. Tankers halting near Hormuz is not a social media talking point. It's a real-world transmission channel into energy and inflation expectations. These aren't healthy system signals. Now your weekly action checklist. Exactly 4 instructions. No drama, just discipline. 1. Reduce concentration risk. Don't let one asset class or one macro outcome decide your financial year. 2. Fixed duration. Time lock risk. Make sure you're not trapped in long-duration exposure you can't adjust when volatility spikes. 3. Improve custody, control. Know what you truly own versus what you have exposure to, and tighten that gap. 4. Strengthen structural diversification. Spread risk across instruments that fail differently under stress, not the ones that fail together. This is not a trade. This is insurance. Now, before we close, I'm going to resolve the questions I asked earlier with clean logic. Now remember the question I asked earlier. If liquidity is fine, why is gold acting like a stress asset instead of an inflation asset? Here's what most investors overlook. Gold can rally on liquidity fear even when nominal rates are not low. When volatility rises and geopolitical risk threatens energy supply chains, investors pay up for assets that are not someone else's liability. That's why gold can move even with the Fed still at 3.50%, 3.75%, and SOFR near 3.67%. This is where it connects. Second question. If you own gold through an ETF or futures, what do you actually own when settlement gets stressed? You own exposure inside layer 1, the financial claim layer. It's powerful and it's liquid until liquidity is the thing that's stressed. That's why watching paper positioning like futures open interest matters, and why the CME market structure matters when volatility rises. That's the risk. Third question. If the Middle East escalates and energy becomes the transmission channel, where does the first break show up? Funding markets, credit spreads, or exchange inventory? The first break usually shows up where leverage lives, funding and volatility. That's why SOFR and volatility indexes matter first. Credit spreads, like the 2.98% high-yield OAS, often lag until the stress persists, and inventory pressure becomes visible when the market begins to demand settlement reality instead of exposure, especially in metals. That's the stress chain. Fourth question, and if markets are closed, what does that really mean? Closed for you or closed for price discovery? It means price discovery concentrates into fewer venues and thinner liquidity. Weekends don't stop risk, they compress it. When futures reopen, repricing can gap. And when repricing gaps, margin and liquidity decisions get forced fast. That's the trap. So when you see a headline screaming 5,194 gold and $120 silver, don't get hypnotized by the number. Ask the real question. Is the system paying up for stress insurance? Because the verified data already says something is shifting. Gold is up hard at 5,278, silver is up even harder near 93.66, gold volatility is elevated, and geopolitical escalation is now a live transmission channel into energy and funding conditions. And that's the signal, that's the stress, that's the risk. Now I want a forced choice answer from you in the comments. Are we looking at A liquidity-driven correction, where funding and volatility lead the story? Or B, settlement-driven stress, where paper claims and real availability start to diverge. Follow and subscribe if you want the clean mechanism instead of the noisy headline. And share this with someone who still thinks markets closed means risk paused. This is education, not financial advice. The only question is whether you act while exits are open. Stay sharp, stay informed, stay ahead.